Hi, welcome to Challenge JP. My name is Jacek, and today I'm going to show you how to create a monthly budget forecast in Excel.
Okay, let's go to our monthly budget. So what I did in the spreadsheet, first of all, I've started with actuals. Here I'm just using the 3 months as an example. So I'm assuming that my budget will start in January 2024. And I just want to put some of the actuals from the 3 months before to give me an idea of my starting point for the budget. You can obviously insert more rows if you want to, but for the purpose of this spreadsheet, I'm assuming that last 3 months will be enough. So as you will see, I'm listing here. I've added rows here for sales. So the sales will be the main driver of my revenues, and then also the direct cost of sales. So I'm assuming that I'm going to take the average of my last 3 months sales as my starting point. And then I'm also going to add, so you'll see that's the calculation of average. I'm just taking those 3 numbers from October to for October, November, and December. And then I'm also going to assume that on a monthly basis, I will be increasing my sales by a certain percentage. So you'll see that in this model, I'm using a bit of a color coding. Whenever you see that sandy yellow, that means that's the input, that's the assumptions. So it's quite clearly visible where which cells are your inputs. So I assume here that I'm going to increase my monthly sales by 1.5%. So I simply inserted the 1.5 here. I could change that number, for example, to 1%, and you'll see that if I change that to 1%, my monthly sales also will change. Basically, I'm saying here that take the average from the last 3 months using your actuals, and then add 1% on top of that, and then so that would be for January, and then for example in February, I'm saying here I'm using this formula where it says, okay, well, take the previous month's sales and then again increase it by 1%. You'll see that I've listed all those increases here monthly, which means you can actually overwrite any of those monthly increases at any point. So for example, you could, for example, here say, okay, increase your sales by 1% for the first 3 months, and then just keep it flat. Okay, so in this case, you would have to overwrite it. Simply insert a 0 here, and then maybe make sure that you've changed the formatting of the cell, so you can see that there was a manual input here, and then all the monthly sales increases follow. In addition to to what I mentioned before, I'm also using some adjustments here, and I'm using that for other inputs as well. So that allows you to, for example, say that, okay, maybe you actually expect a decrease in your sales compared to a previous year. So you can say in this case, let's say if you expect 25% decrease in your sales, you can lower that starting point by 25%, and then maybe you can slowly increase it again over time. In terms of the revenue calculations, again, I have here my actuals for the average revenue per sale, which then allows me to calculate that average here, just the same way as I did it with my monthly sales. I'm assuming that there will be some increase to my monthly revenue, or to my average revenue per sale. So you see that number keeps going up by 0.5% on a monthly basis. And in order for me to calculate the proceeds from sales, here I'm simply taking the number of my sales from this row 16, and then I multiply it by revenue per sale. Okay, and then we have our cost of sales. So what I'm doing in here, I'm just calculating my cost of sales using, again, my previous years, 3 months from my previous year. I'm simply taking, okay, well, if taking the sum of my cost of goods, then divided by my total sales. So that gives me my average cost of goods per sale. I'm adding an increase in that monthly sale here by 75.75%. And then also I can adjust that starting point in here. I've also taken my shipments cost from the 3 last months of the previous year and divided by the number of sales. That gave me my average shipment cost per sale. And again here, I'm adjusting that cost by the increase which I take from the row over here. So I'm adjusting, in this case, I'm increasing the shipment cost by 0.5%. Okay, and then I'm also using some other assumptions like payment processing as a percentage of revenues. So here I simply take the my payment processing fees from the previous year and then divide it by the revenues, and then some other costs which I also calculated as the percentage of revenue. That allows me then to calculate the cost of sales here. So with the assumptions, so the idea of the spreadsheet is that you list all the inputs, all the assumptions on top of the page, so you can clearly see how they are linked or how they're related to each other. And then it should be quite simple to calculate it, for example, cost of goods in your budget. So let's say here, I know that my total number of sales from the top is almost 1.5 thousand. Again, I've calculated that my cost of goods per sale is 472. So I just simply multiplied one number by another, and that gives me my answer, almost 7,000 in cost of goods sold. Yeah, so you'll see that that cost of goods is just a function of my sales numbers coming from this row, and then the cost of good input, which is that which comes from that row number 30. Then I apply that formula also in here, and the only exception is that I'm using now shipment per sale, not cost of goods. So I take the number of sales and then I multiply it by my average shipment per sale assumption. So that gives me that answer here. And then for the payment processing, I'm just taking the assumption here, which is 1.23%, and then multiply by my revenues, and then other costs. Okay, that allows me to calculate my total cost of sales or direct costs. That allows me to calculate my gross margin, and then I can start budgeting my headcount. So here in my example, I'm assuming that I'll have one CEO, I have one financial director, I'll have 3 employees working in the operational department, and then for the other, I just kept for the other function, I just kept 0. And then again, as similarly to previous assumptions, I'm listing all of them on a monthly basis. So at any point, for example, if you feel like, okay, I want to start with 3 employees in January, but then I want to increase operations to, let's say, 5, you could always go here, change it to 5, and then you will see that starting from, for example, in here, May 2024, you will increase the number of operations from 3 to 5, and then that 5 carries forward. Anytime you do that, anytime you have a new input in those monthly assumptions, just make sure that you maybe highlight it in color so you can visibly see that there was a change in your assumption. So to do that, you can just click on that cell here, which is the cell that you want to copy formatting from, and then go to your home, and then click on the format painter in here, and then you can change that to 5. Okay, so let's leave it actually there. Let's leave it at 5 in May 2024, so you can see there will be actually an increase in your salaries. Okay, then again, similarly to my cost before, assuming that I will base my salaries based on the numbers from the last 3 months of the previous year, but then I want to also add some increase at the beginning of the year. So I will assume that for all of the salaries here from my last month of the previous year, I'm going to add, let's say in the case of the CEO, 8% in January. Okay, so you'll see that there was an 8% increase from almost 7.1 thousand, let's say dollars or pounds, to 7.65, which is that reflection of 8% increase. And then you see that there was no increase in February. That simply assumes that you have one increase at the beginning of the year, and then that salary carries forward for the remainder of the year. And now with my headcount numbers and then my average salaries, I can calculate the total salaries. So you'll see here, simply taking the number, for example, for the CEO, I'm saying, okay, well, take that number one and multiply it by 7.6 or 7,650 dollars. Then take the financial director here one, multiply by 5,850, and then take the headcount three, multiply it by that average salary of 4.125. Okay. Here you see that in this, rather than just having those separate multiplications, I'm using the sum product formula, which is exactly the function of the sum product formula here is to do exactly what it is described. So take the number of headcount and then multiply it by the relevant row to get to the total number. Then on top of that, I'm adding some employer tax or other contributions. And then here I have my bonus. So we have a staff cost, and I've also added some operating expenses. So here I'm just assuming that you take the average, for example, of your office costs from the 3 months of the previous year, and then again you adding some monthly increase on top of that, right? So you see that office costs increases slightly. Same thing with, for example, IT, admin, and then I have contingency. And the way I calculate contingency here is that I take the costs here and I take 20% of my above costs to give me a bit of a room just in case if there is any expenses that I haven't budgeted for. Okay, and with that, I can calculate the EBITDA, which is simply, in this case, my gross margin minus my staff costs minus my operating expenses. Then I also need to add some tax estimates, which allows me to calculate profit. Now, in terms of the cash, I need to make some adjustments. So I actually want to show also a very, very simplified balance sheet or your cash movements in the next year. And in order for me to do it, I need to make a few adjustments. First of all, when it comes to tax, I'm assuming this model assumes that your tax is accrued on a monthly basis, and actually you pay the tax one time, let's say at the end of the year. And then for the other calculations I use here is also a bonus accrual. So I'm going to assume that you don't pay your bonus on a monthly basis. That bonus is paid at the end of the year. So it's a similar calculation to what I did with tax. So I'm having my cumulative salaries here. I'm adding those salaries month by month in here. So I'm tracking the total for year to date of my salaries. I'm assuming that I'll get in average, my bonus will be at 10% of the salaries. So that gives me my cumulative bonus. So that's how my bonus pot is accumulating over the year. And then I'm assuming here that the bonus will be paid in month 12. So then in terms of cash, I can see that I receive almost $6,000. And then here I want to track my cash balance at the end of the month. So I'm simply taking the cash balance from the previous month. So in this case, I'm assuming I had at the end of the previous year, I had 25,000 say dollars in my account, and then I'm just adding that incremental net cash from my current month. So we'll see that the cash is increasing, and then is increasing, and then it's suddenly goes from 56,000 to 17,000, and that's related to that big bonus payment that I have to do at the end of the year. Finally, let's go to our long-term forecast. So while budget was dealing with monthly revenue and expenses, the forecast would simply look at the bigger picture and long-term plan. So here we'll be using the just annual inputs and annual numbers. So the structure of the forecast, the long-term plan, will reflect the same structure as we use in the budget. We start with the sales, the revenues, then cost of sales, then headcount, then the salaries, staff cost, operating expenses, all the way to the cash movements. And then you will see that the first column is my year 2024. So I will simply summarize all my revenues, sales, and expenses from using my budget sheet. And then for the future years, so for example, for 2025, so for my forecast, I will use some yearly assumptions. So for example, in here, I'm assuming that my sales will grow on a year-to-year basis by 2%, which is reflected in the numbers here. For example, my average revenue will increase by 3%, which will allow me to calculate my total revenues for that year. Then similarly, I'll have my cost of goods and shipment costs, for example, here. So again, I'll assume that they will increase by 2% and 3.5% for cost of goods and shipment costs, respectively. So that's reflected in here. That allows me to calculate those costs in total based on the number of sales and that input. Similarly, I have the calculations of payment processing or other costs as a percentage of revenue. So that allows me to calculate those lines in here. That gives me my total cost of sales, gross margin, and then again, I have my headcount here. So I can make some assumptions as to how my headcount is going to look like in the future. I'm assuming that I'll keep the same structure, but again, you can change that number at any given point in time. Here, I'm having some annual salary increases assumptions on a yearly basis, which reflects my annual salary per function. And that allows me to calculate my total salary simply by taking the headcounts and then multiplying them by respective average salaries. I'm adding on top of that my other costs, like for example, any taxes that the employer has to take or national insurance, and then some bonus that allows me to calculate my staff cost. Similarly, year-on-year operating expenses, take my budget number, so 2024 is the starting point, and then increase them by 2%. That gives me my total operating expenses. That allows me to calculate my EBITDA, some tax calculations. You'll see that in this case, for example, here I'm assuming I'll just start paying taxes in the later years when I start generating positive income. And finally, I have a simple tracker of my cash. So we will end 2024 with 17,000. Eventually, we'll get into a deficit. So that's the indication that you need to raise some capital in order to fund your company in the future years. And eventually, you come back to a positive cash later on. And then you'll see here that I've listed actually all the main assumptions to the right of the table. Doing that will allow you to quickly sort of stress test your model on your plan. So for example, you can change any of the assumptions here. Let's say we have an assumption for your revenues for an increase in your average revenues, which was 3%. So let's see what happens when I change it to 5%. Just look at the number here. Yeah, you see that all those numbers that the model now have changed. The revenue calculations have changed. The revenues have increased because your average revenues assumptions inputs increase as well, and they're all linked to each other. Similarly, you can, for example, see, okay, well, what will happen to my salaries or to my overall profit? For example, if I were to increase salaries by, let's say, 5% for all of my functions. So in this case, I can change it to a 5. So you see that actually that profit estimate it looks like it's a small increase, 3.5% to 5%, because of the compounding effect of that increase. You see actually that your profit, you're not making any profit. You're just making basically a loss throughout all those years. If I go back to my original assumption, 3.5%, you see that, okay, you're making a loss in those early years, but at least you start making profit later on, okay? Lastly, I put here a graph that shows what happens to your revenues, your costs, and also your cash balance. So you'll see that your cash balance is increasing here until April, and then you see there was it stays more or less here. You see it stays more or less flat, close to 50,000, and there was a big drop to that 17,000. So remember what we did in the model. I did a small modification here. So I've added that additional 2 staff members in May, and then also you have those bonus payments at the end of the year. So you can see that adding those 2 additional staff members have quite an impact on your cost and on your cash here. And then finally, you see that that bonus payment has put quite a dent in your cash balance at the end of the year.
I hope you enjoyed this tutorial. If you have any questions, please visit my website at www.challengejp.com, or to download the template, follow the link which you will find in the description of this video. Thank you very much.